Hey guys, All in Crypto here, and welcome back, beautiful people, for another YouTube video. This is going to be your daily cryptocurrency market update. I'm not sure what's going on with YouTube views. There's been a lot of reports that it's messing up and actually isn't registering them. So if you guys can do me a massive favor, make sure you smash that like button, hit that subscribe button if you're not already, and of course leave a comment to really help me get up there in the algorithm and promote some of the realest content that you're going to find on the tube when it comes to the cryptocurrency markets. That would do me a big favor. So today we're going to be looking at things. Monday was a good day for the cryptocurrency markets, and we're in this kind of full swing in regards to the January effect. People sell in December and look to harvest tax losses and then buy back in January. And we've currently stated that where Bitcoin and crypto is currently, we aren't bears or bulls here necessarily. We're more neutral. Even though we think that we're in a real shitty macro environment, that we think that a recession is very likely, and typically markets don't bottom in recessions, and our base case is almost that there's more downside on the horizon. We're not as bearish as we once have been. And I think people that are overly bearish now, many of them have only recently turned bearish. You're late to the party, and it doesn't make much sense. Now, on Thursday, I think all markets are going to be like a deer in the headlights from now until Thursday, because we've got the US CPI. This is so important because we know the whole reason markets sold off in the first place was as a result of what the Federal Reserve are doing, and of course the effects that this has on liquidity, money, and the way that it redirects it into a very overly indebted debt market, if that makes sense. And essentially they've been doing this to fight inflation. They've been doing this to kill off demand and bring it in line with supply. This is stuff that we've been covering for a long time now. And on Thursday, which is the 12th of December, we have another CPI print coming out. And this is going to be crucial because this is going to steer the Fed in the direction that they are going. Now, I have speculated with my community. We did a study on the 2-year yields for the government bonds in the US and how this leads the interest rates. And based on that, we think the worst is behind us in terms of macro tightening, the economic tightening that's going on. We also have a lowering in terms of inflation. When you have a consecutive lower lows, that is a trend. We have a trending lower inflation. We have looked at a number of prices. This is natural gas, which is at pre-war levels. We've looked at wheat, which is at pre-war levels, and of course oil, which is at pre-war levels. Doesn't mean that they don't spike up, and maybe you've got a bit of a double bottom forming here for natural gas. But we do think the worst is behind us in terms of rate hikes. And Thursday's CPI is going to be very telling. Does it come out higher? Does it come out lower? If it comes out lower, I expect markets to rally. Maybe they sell off initially, but then we'll rally back up in, because it kind of predicts that what the Fed is doing is working and they don't need to be as aggressive as they maybe have set out. And if we look at actually how much interest rates are getting priced in, I'll make my head a little bit small. I did get a comment saying that they can't quite see the screen as a result of this. If we look at interest rates and just how aggressively they're being priced in, this is the 30-day Fed funds futures. We can see that you are getting a little bit of a easing of pricing. So right now, interest rates are currently priced at 4.635%. No, is that right? Yeah, 4.635%. So the Fed is currently at 4.1, 4.2. So this means that potentially the Fed doesn't have that much, and I'll show you very quickly the relationship between the 2-year government bonds and the Fed funds rate. For anybody that's interested, we did do a full Patreon update on this where we really look at this in depth and we try and adjust our investment strategy accordingly based on sort of the overall landscape of things, which really controls our very speculative market. The cryptocurrency space is very much still a speculative asset. We are evolving and moving into an asset class that derives its value from usage. But then you could almost argue, I mean, if you look at the stock market trades at some stocks 16, 17 times earnings, which shows that there's a kind of speculative bubble everywhere. But to stick on the subject at hand, is Thursday is going to be very, very interesting. You can see as rates rise, you can see the crypto market sold off. This is in preempt of the rates rising. This, of course, isn't just a crypto, an asymptomatic to crypto, but across the board. So Thursday CPI is going to be telling, because if it comes out lower, markets will rejoice. If it comes out higher, then markets will probably, you'll see interest rates get priced in more aggressively and maybe see that tumble to the downside a little bit further. Like I say, I'm not bullish or bearish here. I think we've had a lot of big actors taken out. We did say you got this double bottom forming. This is a structure that I'll typically trade. It's typically quite a positive structure. And we are running right into resistance. You guys will know that we did do the daily and we haven't got back around to them just because we've been super busy, where we'd drawn this and it's basically followed it to a T. You did run into, this is our first target, this is our second target that you fell short of. We're chopping up the daily ranges. That's how I typically day trade. But we're going to get back into that once we've sort of really worked out our investment thesis moving forwards. Forgive me. So, yeah, this is going to be big. I think that markets likely are going to, if you look at the futures market, the futures are selling off. We've got gold not doing a lot. We've got the FTSE that's up. And then we've got the dollar, which got absolutely smashed over the past couple of days. Now, this has quite a bit to do with what Japan are doing with their yield curve control. But potentially the dollar's come down because it's predicting, and this is my prediction, that inflation's going to have came out slightly lower, which means that they're going to be less aggressive from a Federal Reserve point of view. And actually, that means that there's going to be less strength put behind the dollar, or the dollar's going to be less strong against other currencies because there's going to be less hikes on the back end of it. So we'll see what we get. I'm really just wanting to see what happens on Thursday. I'm looking to take advantage of whatever volatility takes place on the run up to that and then prior it. But in terms of our macro investment thesis, or our sort of larger term time investment thesis, we're not necessarily bearish here, but we're just not bullish. I think people that, like I say, are overly bearish right now, they've kind of, they're late to the trend, really. There is this sort of pocket of hot air underneath us. I'll go get ahead and get rid of my face. There's this very much pocket of hot air underneath us that we may trade into. We're not under any illusions that this may happen, okay? It's not out the realms of possibility. This may just be a natural progression for markets, as we still do have these extremely tight monetary conditions. If we look at, just today, Coinbase slashes 20% of the workforce in the second major round of job cuts. You've also got some positive news, which is the fact that China, of course, has reopened. JP Morgan is speculating in Australia, but this will be mirrored across the world to a degree. Its economy is looking to rise by 1%. So there's good and bad. I still, again, do think it's a shitty macro environment, and this does kind of predict that markets are going to continue to go lower. But how much lower, we don't know. Do we come back and just sort of hover around these lows and consolidate for a while? Do we smash through them, come down to these levels and then consolidate? Or do we get, some sort of black swan? We still do think there's a black swan event potentially on the horizon. I think the macro conditions are shit. There's a black swan potentially coming, which the yield curve, of course, is predicting. Let's pull that up again just to show people. Where are we? So we're not bulls. We're just not majorly bearish here. It doesn't make sense to me to be super, super bearish when the cryptocurrency market's come down as much as it has, and you're kind of late to the trend. Just because it's come down a certain amount, it's 75% down, it could go down another 75%. You just don't know. But there are ways you can hedge that, and this is strategies that I sort of formulate with my Patreon members to try and, hedge our bets, if you will. So I'm not really sure what plays out. For me, it's all about looking. We did do 4-year cycle analysis. This is, the chart. We've been on this like a hound, and these are the two sort of scenarios that we had speculated just before FTX had crashed. Both involved downside. We didn't know it was going to be FTX at the time, but we had sort of speculated these two scenarios. This is a sort of 2008 style, and then we've got March 2020. One of these two scenarios, I think, is going to play out again. Whether we have that yield curve crash and we get that March 2020 and it forces the Fed to pivot, which is initially bearish, and they have to stimulate, which of course is eventually bullish, or whether we get this sort of slow bleed out and things, a softer landing or a harsher one, is what we're really looking at moving forwards. But we will keep you up to date with that on this channel. I am going to have to keep this one short and sweet, guys. It was just a general overview. What are we looking at today? Let's drop down to our daily sort of chopped up range. We will come back and put in the daily ranges here and look at this as a trend. what we're really doing here is chopping up the daily. I've got my chart set to the New York time zone because it's obviously when the largest amount of volatility comes into the market or volume. This is still an uptrend until proven otherwise. Do you hold this level? Well, you're currently holding it now. We did make that target. It's really, going to be trying to see what happens. Or do you spill it, come back to these levels, rest for a bit into the CPI when you get a bit of a wobbler, and then see that continuation to the upside? You've got a lot of insufficiency here that I think you may look to take. Remember, we did call and have called quite a few good rallies here. I'm not really too sure on the daily time frame. For me, it's all about sort of sitting back, trying to get an investment thesis put together moving forwards into 2023, which we've said is going to be the year that we invest again. Whether it's now or not is still to be seen. We're not calling bottoms. We're not calling, we think further downside is likely, but we're not necessarily calling it. We're just saying we're going to stay neutral until the market shows us its hand, and then we're going to act accordingly. And I think that's where you want to be. It's going to be a lot less stressful, and you're going to do a lot better. That is all I've got for you in this video. Remember, guys, Thursday's the big day. On that note, I am going to love and leave you all. Hopefully, you've all had a triumphant Tuesday, and I'll see you all in the next YouTube video. Thanks a lot for watching, ladies and gents.